Hey friends, today we're diving into 5 Singapore REITs taking action against higher for longer interest rates. Most investors think rising interest rates automatically spell disaster for REITs, but here's the twist. Some savvy REITs are actually thriving despite these challenges. These aren't just surviving, they're implementing smart strategies to protect your investments. As someone who's been analyzing REITs for years, I've seen firsthand how these particular Singapore REITs have outperformed expectations. In fact, during my recent market analysis, these 5 stood out with their proactive approaches. Here's what we'll cover. First, we'll explore how Keppel DC REIT is leveraging data center demand. Then, we'll examine Frasers Centrepoint Trust's innovative mall upgrades. Next, we'll look at Mapletree Pan Asia Commercial Trust's strategic divestments. After that, we'll analyze Mapletree Logistics Trust's portfolio optimization. Finally, we'll discuss CapitaLand Integrated Commercial Trust's aggressive expansion strategy. Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 768,000 reads and 53,000 likes. I've produced over 700 videos with more than 300,000 watch hours as of December 2024. I also focus on regional and world economy topics. Let's start with Mapletree Logistics Trust, SGX M44U, because their approach is particularly fascinating. Think of MLT like a master chef constantly refreshing their ingredients. With an impressive portfolio of 183 properties across 8 countries, they've been actively recycling capital like pros. Imagine you have an old phone. Would you keep it forever? Probably not. That's exactly what MLT did with 13 older properties last year, selling them all above market value. Now here's where it gets really interesting. They took that money and invested in modern logistics facilities in Malaysia and Vietnam with initial yields between 5.7% and 7.5%. It's like trading up from an old compact car to a brand new SUV. Plus, their ongoing projects at Benoi Road and Subang are creating massive new space. Think of it as expanding your storage from a small closet to a whole warehouse. And get this, they achieved a solid 3.4% rental increase across their portfolio. Why does this matter to you? Because MLT shows us that even in tough times, smart asset management can lead to growth. Their strategy proves that sometimes you need to let go of the old to make room for better opportunities. That's a game changer, but wait until you hear about Keppel DC REIT, SGX, AJBU. This one's my top pick for good reason. Picture a digital fortress. That's essentially what Keppel DC REIT is building. With 25 data centers across 10 countries, they're tapping into the insatiable global demand for data storage. Last year alone, their revenue jumped 10.3% to $310.3 million. Pretty impressive, right? Here's the kicker. They managed to boost their distribution per unit by 0.7% despite higher interest rates. How? Through brilliant timing. They bought a Tokyo data center at just the right moment while selling their Kelsterbach property for $70.6 million. It's like knowing exactly when to buy low and sell high in the stock market. Even better, their rental reversion was a whopping 39%. Imagine getting nearly 40% more rent when your lease renews. This matters because it shows how specialized REITs can thrive regardless of interest rate environments. Data centers are becoming as essential as electricity in our digital age. Now let's talk about Frasers Centrepoint Trust, SGX J69U. If you've ever wondered why suburban malls stay busy while city centers struggle, FCT has the answer. Their 9 retail malls are like community hubs, consistently delivering strong results. Just look at their Tampines 1 renovation. They created 9,000 square feet of new space and earned over 8% return on investment. That's like adding a profitable extension to your house without moving. They're not stopping there. Their Hugang Mall upgrade aims for a 7% ROI and promises to bring fresh experiences to shoppers. Here's a personal insight. I visited Tampines 1 after their AEI, and the transformation was remarkable. It felt like walking into a completely new mall. Have you noticed how some malls feel dated while others seem to reinvent themselves? That's exactly what FCT excels at. These upgrades matter because they create a virtuous cycle. Better spaces attract better tenants who pay higher rents, ultimately benefiting unit holders. It's retail evolution in action. Speaking of evolution, let's examine Mapletree Pan Asia Commercial Trust, SGX N2IU. Operating across 5 Asian markets, Impact plays a sophisticated game of portfolio chess. Their crown jewel, Vivo City, is undergoing a phased upgrade that's expected to yield over 10% ROI. Imagine giving your flagship store a makeover that not only looks great, but pays for itself handsomely. Their strategic divestment of Mapletree Anson demonstrates another key lesson. Sometimes letting go of underperforming assets boosts overall performance. It's similar to pruning plants. Cutting back weak branches helps the whole plant grow stronger. The Trust's consistent 4.6% rental reversion across its portfolio shows their properties remain highly desirable despite market challenges. This approach matters because it illustrates how Pan-Asian exposure can provide stability through diversification. When one market slows, others might be booming. It's like having multiple income streams in your personal finances. Finally, we come to CapitaLand Integrated Commercial Trust, SGX C38U. Talk about playing both sides of the field. CICT combines retail and commercial properties across 3 continents. Their recent acquisition of a 50% stake in Ion Orchard for $1.8 billion shows they're not afraid to make bold moves. It's like buying prime real estate in the best neighborhood. Expensive upfront, but potentially very rewarding long-term. Their rental reversions tell an impressive story. 8.8% for retail and 11.1% for office spaces. To put that in perspective, imagine your landlord asking for a 10% rent increase. Now flip that scenario and you're the one collecting it. The sale of 21 Collier Quay at a 3.5% exit yield provides valuable liquidity for future opportunities. This matters because CICT demonstrates how scale and diversification can create resilience. Their dual-pronged approach covers both retail and office sectors, reducing reliance on any single market segment. Ever wondered how big REITs manage risk? This is textbook execution. Let's recap what we've covered today. We explored how MLT's capital recycling creates growth opportunities, Keppel DC REIT's data center dominance defies market trends, FCT's suburban mall upgrades drive consistent returns, Impact's strategic divestments enhance portfolio quality, and CICT's bold acquisitions position them for long-term success. Now you're equipped with knowledge about REITs that aren't just surviving but thriving in this challenging interest rate environment. Remember, successful investing isn't about avoiding risks. It's about understanding which risks are worth taking. But here's the exciting part. If you're curious about how Singapore Budget 2025 is turbocharging these REITs, I've got something special for you. Want to know how Singapore's Budget 2025 impacts CICT and FCT? Join me, your friendly Investing Iguana, as we dive into this packed with insights episode. In that video, I break down how government initiatives like household vouchers and tax incentives are shaping investment decisions. These policies are a game changer for retail REITs like CICT and FCT. Imagine suburban malls buzzing with families cashing in their vouchers or prime locations like Orchard Road benefiting from increased consumer spending. It's all connected. From HDB expansions to global tax policies, these factors are boosting rental incomes and setting the stage for exciting developments. Whether you're an investor eyeing stable yields or just curious about economic strategies, this video connects the dots between consumer spending, government support, and the future of REITs. You'll learn why these REITs are poised to grow even stronger and get practical tips to sharpen your financial analysis skills. Plus, I'll share insights on how to make informed investment decisions that align with these macroeconomic shifts. I want to hear from you. Which of these strategies do you find most compelling? Or maybe you've invested in one of these REITs. How's your experience been? Share your thoughts in the comments below. Before you go, check out my video, Singapore Budget 2025 Makes These REITs Rich. It's a must-watch if you want to understand how government policies are supercharging CICT, FCT, and other retail-focused REITs. The link's right here or in the description below.